Rate cuts are coming in right now. No, I'm just kidding, not a rate cut. We're getting an initial move. It is now 11 o'clock. It is Wednesday, June 17th. Federal Reserve just released their initial Fed rate decision, and the press conference is coming up in 30 minutes. I'm looking to take a trade, looking for an opportunity for some type of return on either side, outsized asymmetric return. And actually, let me go ahead and fix that. So this right here, we're consolidating, consolidating today, walking back from the past day or two over the gap up over the weekend. SpaceX under 200 today. But if you look at the 4-hour chart on QQQ, we're still holding above this 9 EMA on the 4-hour chart, and the daily, the 21's down here at 725. The 4-hour 9 EMA is at 728.76. The daily chart 9 EMA is at 725, 726 area, and then obviously at 720-ish for the 21 EMA on the daily chart. So I'm looking for obviously for these areas to hold as support if we do come down and get a liquidity trap below this level. This is what I would consider a bull flag coming up from here. Even though we got a gap up, we're walking back into the support in between this level. We can get a liquidity trap somewhere down here and then bounce up higher today. Could definitely happen. Kevin Warsh will be speaking in 30 minutes from now. And so I gotta check where they're at. But that's basically the TA technical analysis I'm looking at, is just this simple on SPY. It's a very simple walk back after the gap up. These are past 4-hour candles. Right into support at the 9 EMA. We could liquidity trap down into this support level, which is aligned here with the 21 EMA on SPY around 746. So the Fed is still, the Fed, I believe, is holding rates steady, and they're still holding their bias, being with monetary policy easing. There you go, SPY breaking below that low. QQQ could follow through. Just looking at the 4-hour chart, 9 and 21 EMAs for a liquidity sweep if we do pull back into support, and then going into the actual press conference where they start speaking, we'll get a much better idea when Kevin Warsh starts speaking. We're getting that big red candle coming in here. A few dollars. Fed removes additional references to rate cuts or rate adjustments. Okay. Getting a nice red candle here. On the futures, well, these futures are delayed, so it's not really worth looking at right now, which kind of sucks. So today the dot plot and the standard this summary of economic projections is also being released just now. The Fed policymakers are expecting stronger and more persistent inflation, with 2026 PCE, their preferred inflation measure, seen at 3.6% versus 2.7%. They're not projecting inflation to return to the 2% target until 2028. Okay, SPY is already pulling back into that 21. We're getting that move down to this 21 on the 4-hour. Daily chart is a little bit lower. 21, or the 9 EMA on the daily chart on QQQ, sitting at 725 flat. So watch out for that 725 and then 720 below. That's what I'm looking at on Qs. On SPY, we're already down there on the 4-hour chart. On this chart, well, it's taking a while to load. Yeah, the 21 is at 740, just under 743. And oil once again pushing another candle low. The daily chart is kind of a inside, but this 3-day chart shows a really clear picture. This coming right back into where it came from. Big gap down over the weekend. 3-bar pattern. A little bit of volatility coming in right now. Pretty decent move. Wow. All right. So that's the move. So far we're getting that move down, which is I'm expecting a move down, and then obviously during the speech, during the press conference here in about 25 minutes, I'm expecting it to possibly turn around. May not come all the way back up to that 733 area, but definitely expecting it to turn around. Off the support levels on the 4-hour and daily charts, 9 and 21 EMAs, just keeping it that simple. My count's at $145.57 from yesterday, up 188% so far, which is pretty good. I'm gonna pull up this option chain, see what it looks like right now. I'm sure these options just like tripled right now of that move. These options are very expensive. So at the money calls and puts on QQQ right now, with 2 hours left in the market, are $300 each. Absolutely insane. So if I wanted to get something for 50 bucks, I mean, we're at 726. I'd have to go down to even a 715 or 14, which is 10, 11 strikes out the money, is 50, 40 cents. So I'm definitely going to be waiting until during or even after the press conference to catch a move, because these contracts are overly priced. I didn't actually expect them to be so expensive. I mean, SPY is a little bit better, but it's still like on SPY we're at 745, and I would still have to go down 7-8 strikes to a 738, 737 for 30, 40 cents. So that's interesting. Definitely focus on QQQ, although the contracts are very, like, price is expensive almost at SPY right now for some reason. So some of the interesting things that I think Kevin Warsh could say. Kevin Warsh in the super cycle, the wealth transfer, they're buying gold, they're buying treasuries, they're buying bonds, they're buying gold. They're going to deregulate the banks. Supplementary leverage ratio will be removed or eased, which is basically quantitative easing through the banks, which means the banks are able to buy unlimited treasuries. They're able to basically manage their funds and their capital more effectively and have a bit more freedom, which this changed after the 2009-2008 financial crisis. Some of the things that I think Kevin Warsh may say, or that will be interesting, or that would be at least like, the quote, the most entertaining outcome is the most likely. So just consider that. And I think some of the things that I would like to see coming from from Kevin Warsh, not Jerome Powell, is something around, easing monetary policy, loose policy, maybe even talking about Iran and the supply shock, the oil, strategic petroleum reserves, supporting the bond market, which is basically a positive quantitative easing method, crypto, disinflation, AI technology, innovation, productivity, statistics, all for the concept of disinflation, which is possibly going to be fighting over the next decade against the inflation persistence, which we've seen for the past 6 years. He could also talk about crypto, higher for longer, strategic petroleum reserves. So I would be interested. I don't think they're going to talk about that so much, but it does have to do with the inflation and the supply shock that we have at the moment with the crisis. Not really a crisis, but the strategic petroleum reserve is at the lowest level in like 40 or 50 years, which is really bad. And China's strategic petroleum reserve is like over a billion barrels. We had like 800, 900 million. We almost had 1 billion barrels in SPR. But we had reduced it now to keep gas prices and inflation controlled, over the past few months. So that's the real concern. And so I think it could be something to be talked about, because I think we should work on making a bunch more jobs by drilling, mining, whatever it is, to produce and refine this oil, so that we can, and petroleum, so that we can restock our strategic petroleum reserve back to the all-time high and bigger than China's. I think that's what we need to do, but we need to end the conflict first, which is supposed to be signed tomorrow. On Friday, June 19th, the market will be closed. Juneteenth day, actually. So other things he could say, obviously with the inflation higher for longer, persistence inflation, transitory inflation, he could talk about the dollar. And if the dollar comes down, it would be bullish for stocks, and the dollar weakening signals more of the good type of inflation, inflation in terms of equities rising against dollar weakness. So transitory persistence, the dollar higher for longer, crypto disinflation, loose policy, easing monetary policy, disinflation, SPR, and AI, technology, innovation, productivity. Some of these things, I think, these are like what I would want to hear. Him taking all these different concepts and using them to integrate with better, higher quality, higher signal monetary policy decisions. As with the entire Federal Reserve committee is convening, including Jerome Powell. So I think it's really a good time. I think it's an entertaining outcome, which would be bullish in the long term, obviously, is what always happens. But even with possible persistent inflation and constrained job market, while we're waiting for AI to really continue to become disinflationary and allow for further economic expansion outside of just capital expenditure, which means actual productivity increasing. Yes, layoffs may happen, but it's an augmentation of human labor and capital over time, and it's going to make the whole economy more efficient, more productive, and richer. The debt is an instrument. The national debt is just an instrument to invoke some of this type of measures. Obviously, inflation has a lot to do with the money supply, and the money supply has a lot to do with how much we spend and how much that we end up going into, and our relationships with foreign international trade policies and relationships are also very important in terms of having increased revenue. General trade practices such as what you would learn like in middle school, the most basic concept of supply and demand is like, one country like China, for example, they can produce in the past, like silk, for example, they could produce silk at a much faster, much cheaper, reliable pace. And so people go to China to buy silk because it's cheap and they make it cost efficient more than other countries can. And that goes for any country and any product, depending on where and who's able to do it the best with the least, do the most with the least. Obviously, there's other things that go into that. With China's labor practices are unfair and probably terrible. And you don't really want to necessarily be stuck working 12, 16 hours a day, 7 days a week in a warehouse, which maybe a lot of people are forced to do in a place like China. And they don't really get a choice. They don't even get much of an opportunity to live, choose where they live or how they live or what they eat, where they eat, even what to think. They're muted, they're censored. But communist China is communist China. And America is the great innovator, the great wealth state, the capital generator, the innovation exponential, the compounding interest capital of the world. So I just think that the optimistic side of the Fed meeting today is Kevin Warsh coming in and having some general comprehension of all the different aspects with global economics and our domestic economics and politics combined to have a clear picture that he can produce. Possibly quite a bit different than Jerome Powell, or it could even be very similar. But over time, Kevin Warsh has a long history of studying and being prepared for this moment in time. The past 15 years, he's studied law. He's worked for banks and central banks, and he's done it for years in preparation for the new era of monetary policy, which we've entered. Today marks a very important date with the meeting. So there we go. On the 4-hour chart for QQQ, bounced perfectly off of the 21 EMA on the 4-hour chart, right at 725-ish. Low a day on QQQ, 724.53, so swept just below, but now we're getting almost a pullback, like 67% back so far. So that's pretty good. It's about a 67% retracement so far. I mean, yeah, exactly, I think. (61%, 61.8% retracement from the low day. We're at 50% right here, almost into that 61%. See if it's going to reject off that 61%, which is aligned with on the 5-minute chart, the 21 EMA and the VWAP at around 732 and 731.59 for QQQ. So could look for a rejection, but right now we are still digesting the rate decision, the dot plot, and the summary of economic projections. Some of the Fed policy makers see a rate hike this year. 3 months ago, there was none. Rates are unchanged. But I think what Warsh is going to try to do is try to make the case for inflation and inflation, disinflation, the supply shock, and all these factors, requiring a more hands-off approach, which is kind of what Jerome Powell was about in a lot of ways, like a wait-and-see policy, you know, higher for longer, transitory, persistent inflation. And the Fed Chair Kevin Warsh didn't submit a dot on the S&P dot plot, so he decided, you know, the Fed Chair doesn't have to necessarily place his mark on the dot plot, and he chose not to. The Fed lowered GDP projections to 2.4%, and they removed the statement regarding rate adjustments. I want to see how did this actually change. They're saying Fed Chair Kevin Warsh rewrote the what is it? The statement. Let me see. Decided to maintain the target range for the federal funds rate at 3 to 3.5 to 3 to 3.25%. The community policy. Assessing appropriate stance of monetary, or actually reaffirmed its policy of maintaining ample reserves in the banking system. So there's a nudge to the bank deregulations in the SPR, not the Strategic Petroleum Reserve, but the supplemental leverage ratio, SLR, not SPR, SLR, supplemental leverage ratio versus the Strategic Petroleum Reserve. They're different, completely different things. But economic activity is expanding at a solid pace despite elevated uncertainty that owes in part to the conflict in the Middle East. There you go. He's already mentioning Iran. There you go. Productivity growth and capital investment are strong. Job gains have kept pace with the workforce, and the unemployment rate has changed very little. Inflation remains elevated. There you go. Relative to the community's 2% goal, in part reflecting supply shocks. There you go. That's exactly what I was saying. that have driven price increases in certain sectors, including energy. The committee will deliver price stability. So out of the 17 Fed members, 9 of them are on the side of hikes by the end of this year, and the other 8 of them are still more neutral. And they're still expecting rate cuts next year, the following 3 years, as of their statement. The new statement is far leaner, stripping out much of the standard forward guidance language, including the lines about carefully assessing incoming data and being prepared to adjust policy as appropriate if risks emerge. It adds a blunt new declaration: the committee will deliver price stability. There you go. The statement passed 12-0. The prior meeting's dissent's gone. The dot plot now pencils in a rate hike for 2026. A sharp hawkish shift. Yep, and that's exactly what I was saying yesterday. With inflation being higher for longer, innovation remains stronger for longer. But a rate cut may have surprising positive effects. That's just my niche tinfoil take. Warsh is going to talk about AI productivity to push down the neutral rate so market can rally. Well, there you go. That's what I was talking about a couple minutes ago. So we'll see if I said a bunch of different quotes and phrases that Kevin Warsh may talk about, and so far it seems pretty accurate, but we need to hear from him directly. So in about 8 minutes, I'm going to pull it up and watch it together. Pay attention to this. I'm gonna be looking for some important sentences and quotes or language that he says, and taking notes. So I'm gonna play the audio and everything, so it'll be fine. But I gotta take notes. Gotta take notes on the Federal Open Market Committee meeting, the first one with Kevin Warsh. You just have to take notes. So what's that? The other thing too is if they go ahead and pass the ARMA Act and the Clarity Act, that's going to be huge for crypto and digital assets in the coming future. Just like the 1990s and 1996, disinflationary technology has a massive effect, which we have yet to see, and it doesn't show up in the productivity statistics for even a decade most times. That's based on history. So with balance sheet reductions at the Federal Reserve and buying bonds, with replacing or repricing gold to its current price from its previous logged price, in order to acquire 200,000 Bitcoin per year. Just remember that. The federal government will be most likely acquiring 200,000 Bitcoin per year over a 5-year period, in total accumulating 1 million Bitcoin, which is about 4.7% of the total supply, which is 21 million. And they're going to do this by repricing gold and then using the capital from not just the repricing, but from the bank deregulations. And there's something else there, but they're going to be using that capital to move it over out of treasuries or out of gold and balancing it into Bitcoin. And also with the Clarity Act, which is totally different and separate, it's going to add a whole nother effect. And this is possibly happening all by the end of the year, within the next 6 months, 5-6 months, including the rate cut, which I would personally be on the dot plot with a rate cut in September or October, and then next year, mid-year. That's how I would pack on a third hike for the next year. That's just what it is. but the supplementary leverage ratio is how they're going to deregulate the banks and allow them to purchase more treasuries. And repricing gold is going to allow them to accumulate a large amount of new debt, which is a positive thing, to buy Bitcoin. It's new debt, but it's a wealth transfer. It's a super cycle. It's quantitative easing, but it's not normal quantitative easing. It's the kind that's futuristic and based on technology and productivity and new assets that are never been seen before, never created except in America, like Bitcoin. Never been done before. It's only been around since 2009. Remember, Bitcoin's only been out. Crypto's only been around for not even 20 years, not even 2 decades. That's nothing in the scope of time. These things are still infantile and developing. So this is it. That's very interesting that that initial FOMC statement where Kevin Warsh removed half of the language, or he removed like 90% of it and kept it extremely simple. Very interesting. I think the new thing is going to be, instead of the Powell put, it's going to be the Kevin call. The Kevin call, we're going to be buying calls every time Kevin says something dovish. Every time he mentions Bitcoin, every time he mentions productivity or AI, it's dovish. That's the difference between the Powell put being hawkish versus Kevin Warsh being bullish or being dovish. It's the Kevin call. Get ready for the Kevin call. The Kevin call, FOMC, there you go, I coined the term. All right. So here we go. We came down, got this big red candle on the initial release. We came back up 50%, 61.8% was right here at the VWAP in 21, which would have been pretty nice. And obviously this is a previous support level. This is a support level from yesterday. We've been consolidating around it. Almost another weird, this is like some weird, the close yesterday and then this low today. It's a similar double bottom. You see the alignment right here and then the alignment right here on these equal lows. This is gonna act as resistance from here. So unless we get a massive candle up here, this is gonna be very hard to recover, which obviously can happen. More than likely, after we got this bounce into the 50%, which is halfway of this candle right here, we rejected. That was a good spot off the 9 EMA to capture what could be a move lower. And still, the key though is with this is the daily chart on SPY. It almost retested the 21 and it's back above the 9 EMA, but if you look at QQQ, it barely retested the 9 EMA. Still has this gap, which has not been closed. The gap still from yesterday, open at close at 721.34. So this level 721.34. This will be the level to watch next if we do break below the 9 EMA at 725, then 720, 721, 725, 721.34, and then this 21 EMA at 720. It's like perfectly at, oh, it's actually closer to 719 now. On the 4-hour chart, it did a very similar move to SPY. So like the daily chart on SPY looks like the 4-hour chart on QQQ. Daily chart on SPY, 4-hour chart on QQQ. Anyways, we're walking down. We have quite a bit of resistance that we're developing here as we walk these candles down. This is a 4-hour chart into this gap. We closed the other gap here already. This previous gap from the down gap after the inflation reading came in. And then after the weekend gap on the Friday possible ceasefire deal signed with the big deal is still here at that same 721. Well, 721.37 it says here, but no. Well, it's a daily chart gap. So looking to come down even further possibly is the room that we're looking at, and possibly liquidity sweep. So it may be pretty volatile. It may not be super easy to trade this, depending on if the downside comes in reasonably and gives an opportunity to get a solid entry on a retest or so. But obviously, like on SPY, the 4 hour, it looks a bit heavy and it's trying to hold this 21. If it loses it, then we could definitely pull back more. It's already filled the gap. Actually, no, the gap here is. So, all right, so I gotta pull this up now. Let me pull up the meeting. Let me pull the meeting up.
Friends, and you colleagues both, listen closely to my fellow FOMC members. Heard a lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness, commitment to mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do. That is our North Star. My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment.
Price stability, maximum
And
employment.
these objectives guided our business in the meeting just concluded. As you saw a few moments ago, the committee decided to maintain the target range for the Fed funds rate at 3.5 to 3.75% in support of the Fed's dual mandate. The committee also reaffirmed its policy of maintaining ample reserves in the banking system. Economic activity is expanding at a solid pace, despite elevated uncertainty that owes in part to the conflict in the Middle East. Productivity growth and capital investment, both strong. Job gains have kept pace with the workforce, and the unemployment rate has changed little. We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. Persistently high prices are a burden for the American people. But the recent past need not be prologue. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability. At any institution, a change in leadership is a natural and timely opportunity to reaffirm its mission, to review current practices, and to consider whether those practices best meet our objectives. My Fed colleagues and I will be working in close collaboration to ask what changes might improve the conduct of monetary policy. On that score, you might have already noticed something: a difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture. This afternoon, you also received the usual summary of economic projections. It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so. I, however, have refrained from offering any projections of my own, consistent with my long-held views on the SEP, at least as currently structured.
Kevin.
In the median projections, real GDP rises at 2.2% this year, 2.3% next year, and total PC inflation runs at 3.6% this year, 2.3% next year. The unemployment rate stands at about 4.3%. The median participant judges that the appropriate federal funds rate to be at 3.8% at the end of this year and 3.6% at the end of next. Let me turn now to a few words on a key initiative that we're announcing today. I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing
Balance sheet
data
reductions.
sources. Fourth, productivity and jobs in an era of transformation.
Productivity in an
And
era of
last,
transformation.
the Fed's inflation frameworks. These subjects are timely, consequential, and in my view, worthy of a fresh look. My colleagues and I discussed them with energy and purpose over the last couple of days. For each of these independent task forces, I'm enlisting some of the very best minds, both inside and outside the economics profession. They will be supported by subject matter specialists from our superb Fed staff. And they'll have a straightforward charge. Start with first principles. Ask hard questions. Examine current practice. Consider alternatives. And ultimately, propose next steps for policymaker consideration. Since last summer, my colleagues discussed possible improvements in the form and function of Fed communications. This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The third task force, the one on data, will evaluate new information sources and consider methodological changes to improve data gathering, with the aim of giving policymakers more accurate, relevant, contemporaneous, and perhaps most important, actionable information on the state of our economy. Fourth, the task force on productivity and jobs. It'll survey the pace, the reach, the economic impact of new general purpose technologies, including AI, and explore the implications for the Fed in pursuit of our employment and inflation mandates. The last task force, the one on inflation frameworks, that'll examine the drivers of inflation, first principles, and weigh the full range of ideas for delivering price stability in a changing economy. You'll hear quite a bit more about these task forces and this overall initiative in the coming weeks. Enough for now to make a simple statement. Each task force will serve an objective shared by everyone in the system, shared by everyone around that table that I sat with over the last couple of days. A Federal Reserve that is clear-eyed about its mission, fit for purpose, and focused on the future. And with that, I appreciate your attention. I'm happy to take your questions.
Howard Schneider.
There we go. Questions?
Hi, Chairman Howard Schneider with Reuters. Good to see you again, and welcome back. This is a lot to be putting in motion so fast. What is the timeline
Big
you
motion.
have in mind for each of these?
So
chart's still
I think
consolidating.
it'll depend on the task force.
Up to the
It also
61.8%
depends on the
right here at the
urgency in
VWAP.
which we need clear answers. My expectation, I'm still in the business of recruiting and finalizing them. My expectation is the task forces will begin work in the next couple of weeks, and we'll start to get some more information from them, some more framing of how they see things starting in the fall end, hopefully most, if not all of them, concluding by year end.
And just specifically on the inflation framework, you talk about first principles. Does this include a review of the 2% target itself? You've mentioned that things to the right of the decimal point don't matter. Should this be starting from a premise that 2% as a point estimate is too strict?
Let me break that into two pieces. First, on the inflation framework review, their remit is what are the drivers of inflation? What's the Fed's responsibility for inflation? In part, how do we measure inflation? But that'll overlap with my data group. On the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that. So that'll be outside the scope of what we're taking on.
Colby.
2% is enough.
Thank
We
you
need
so
to lock
much,
it,
Colby
pin
Smith
it.
from the New York Times. You've in the past
Pin
said
it
that
at
inflation
2%.
is a choice, and in the policy
Indefinite.
statement,
Linear.
it includes this pledge to
That's part
deliver
of my-
price stability, as you've
my
reiterated
idea.
today. But looking at the SEP, the bulk of
That's all
your
I'll say,
colleagues
linear
expect
inflation
core
rate.
PCE to run around 3.3% by year end, and for the 2% inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces. First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do. In the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. I've said for years inflation is a choice. You bet it is. And today I'm announcing that this committee unambiguously and unanimously have decided we are going to deliver on that. The rest of your questions sounded like a encouragement for me to give forward guidance. We've dropped forward guidance. Some along the committee, I think, dropped it, I suspect, from our discussion the last couple of days, because they said at this moment in time, it doesn't feel as though providing forward guidance is right. Others have, I'd say, different views and think as a general proposition, forward guidance isn't the business we should be in. But that'll be taken up by the Task Force on Communications and my policymaker colleagues. We're going to listen hard to what the experts say and make our own decision. But I can't give any forward guidance about what we're going to do next. The good news is we'll be meeting in 6 weeks.
So just following up, I guess, on the current policy settings, then I am curious how restrictive you think things are at the current moment, given the flow of data that we've seen and, you know, forecasts that are coming down the pipeline.
Yeah, I've heard characterizations both inside and the Fed about that. I'll give you my own. It's uneven. If I look at the housing markets as one example, Fed policy isn't the single determinant of the state of the housing market. But broadly, I would say there, Fed policy appears to be somewhat restrictive. I would have a hard time managing to say those words if I were to see what's happening in financial markets. So I'd say it's uneven. That's perhaps a function of different transmission mechanisms of monetary policy, whether monetary policy is coming from our interest rate tool or our
Wow,
balance
right
sheet
back
tool.
to the initial candle.
The good news, we have a task force on that too,
Almost a
and
full
the balance
recovery.
sheet task force will be looking more at that subject.
That's pretty decent.
Mike McKee.
You've said you don't like forward guidance. You dropped it from the statement this time. But with the dot plot, 9 members suggested that they want a rate increase by the end of the year. And the
9 out
markets
of
have
17.
taken that as forward guidance. So what does this
Right back
mean
to
in
the
terms
top of
of
the candle, wow.
how you guide the markets and in terms of
734 SPY. I mean,
what the
70
dot
734
plot's future is?
I'm going to have to give you the same answer I gave to Ms. Smith. We've got a task force for that. I'll give you a little bit more. I reviewed the dot plots, and when I saw the submissions, I noted that all the submissions were coming in with pencils, you know, those kind with the big erasers. That's to say that I think my colleagues around the table, when they submitted their dots, understand the world is changing quite quickly. And they didn't feel bound by them 6 weeks from now or 6 days from now in the event that their circumstances change. I'll note a couple other things. What I heard around the table was, as they submitted their modal forecasts, to be clear, weren't, this was more likely than not. This was more likely than their other scenarios. So I didn't hear tons of conviction. What I heard was the kind of humility that I think we should have. I did not submit a dot. For me, it's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statements, there'll be a review about communications broadly, press conferences, dots, meetings and the like, transcripts, minutes. This will be part of that. I don't want to prejudge the outcomes there, but I'm pretty open-minded about what they could be. And I was just incredibly impressed over the last couple of days. My colleagues over the last 2 days, and frankly, over the first 3 weeks I've been here, they've been very open about changes. Change isn't easy, change is filled with risk, but our number one goal is to get monetary policy right. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability, and there was no disagreement on any of those points.
At the risk of possibly getting the same answer about task forces, communications, what is your feeling about these news conferences? Are you going to continue one after every meeting? Do you find them useful? What is the future for the way Kevin Warsh will communicate?
Well, this one's probably got another 15 or 20 minutes in it, so I don't want to prejudge the outcome. Press conferences can be a very useful way to communicate with households, businesses, and more broadly through using the likes of you.
Transparency.
I had a great old mentor named George Schultz, and his mantra
Good transparency.
was press conferences are useful.
It's an open
when
market
you have
committee.
One,
That means
you want to make sure
every
you have
single
something
person
important
can
to
listen
say.
to it.
Today,
That's
I think
why
we
we're
have
here.
something important to say about our commitment to deliver on price stability, our commitment to rethink practices with an eye of moving the Fed forward, and to give you and the American people a sense that these aren't idle thoughts, these are concrete thoughts, that we're going to seek out the best minds, both the best thinking inside of the Federal Reserve and the best people I know in business and economics and the academy and technology and the rest, to share their views. That's what we're going to be doing here, the pursuit of truth. I think we're going to come up with some new and interesting things. We made some changes today. I expect more changes to come. And some of those might well be worthy of a press conference.
Chris Rugaber.
Well, there was the Kevin call.
Hi,
You see that?
Chris Rugaber.
That was the
Associated
Kevin call.
Press. Thanks for
Those candles
taking our
right back to new
questions.
highs. There's the Kevin call.
Could you give
I
us a
didn't take it
sense of
'cause
how you
these
see
contracts are too
inflation
expensive, but
more
there's the
in the
Kevin
long
call.
term? I know you may not want to comment on the ups and downs, but is this mainly driven by energy prices in the Iran war at this point, or do you have any concerns about underlying inflation pressures in the economy?
It's
Thank
a
you.
lot. It's a lot to
So I can't
unfold
do
over
much
time.
better than the committee just did. So let me restate it.
This is not simple.
Inflation
this is very
remains
deep and
elevated
complex,
relative to the
and
committee's 2% goal.
much of it is being
in part
withheld, and
reflecting
that's very-
supply shocks that have driven price
It's meant to
increases
be
in certain
this way.
sectors, including energy. The paragraph goes on to say, but to be clear, the Fed will deliver price stability. My own judgment is the
shocks.
committee spent quite a bit of time, not just in 2 days, but over iterations of a couple of weeks. That's what we're prepared to say about inflation, but the commitment to deliver is strong, unanimous, and unambiguous. And that's, I think, an important message. We've missed for 5 years, and we're going to fix that.
Well, great. And then just on the data task force and everything else, I mean, generally speaking, I think people feel the Fed looks at everything already. Certainly, that was the sense from before. Is there data that you feel is not given enough weight? I mean, you mentioned the trimmed mean in the past, but again, that's well known to certainly most Fed members. So what is that task force looking at, and what might be the? I mean, I know you don't want to prejudge the outcome, but are there examples of data that you expect might be given more weight? Thank you.
So you're answering my question. So let me say I don't want to prejudge the outcome. I also don't want to say too much about what they're going to do because I still have a phone call or two to make before I've nailed down the people that are doing that. I'm interested in what the outside experts' view is on the subject. I'll say this generally. Most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods, a national accounts of what the U.S. economy looks like that looks very little like the U.S. economy in 2026. Survey methods that don't have response rates that we need, asking questions that might have been quite applicable a generation ago that are less applicable now. So even inside of official statistics, I would be open-minded if the task force and our own best thinking had recommendations how those official statistics can be brought up to a standard of of our time using new analytic methods. I'd also say this, almost every private company CEO that's running his or her business are doing so with real-time information that isn't subject to much revision, that is telling them what just happened at that very moment. As you know, there are normal, long and variable lags in the conduct of monetary policy. What we're really interested in is what's happening right now. What we're less interested in is echoes of history. And you're hearing from my answer that some of the data that we receive, that we're waiting on, the first Friday after the month, the payroll index or something else, that might be an echo of history that's quite useful on its third revision. We need to take those error bounds down because we have to make hard decisions in real time. I'm really open-minded that there is a lot of new data sources that we can learn from the private sector, from reforms in the official sector, and new analytic techniques that are far more refined than asking a simple question about whether something was core or non-core.
Edward.
Thanks. Welcome, Mr. Chairman. Edward Lawrence with Fox Business. So if you don't give a lot of ongoing forward guidance, won't the markets have more volatility, and shouldn't Americans have more access into what you're thinking going forward?
Transparency. There you go. I just said it.
So I think financial markets perform best.
That would have been my
when
question.
They react to incoming data. I think
There's the
the
Kevin
financial markets work less efficiently when they ask a question, how will the Federal Reserve react to that incoming information? The more that markets are paying attention to what's happening in the real economy, deciding what's good data and what's less good data, the more financial markets can price what they believe is the most likely and what are the tail risks. Financial market prices are probably the most important source of information to guide central bankers. But when all the financial markets are doing is reflecting back what we've said, then we're taking the most important source of information and we're being blind to it. I'd like us to create a system where those blinders come off, where markets are following data that they efficiently think is reliable, and they'll be watching data, we'll be watching data, they'll come with better information through market prices to us, we can make more informed decisions, with ultimately the goal that I said at the outset, deliver on the price stability objective that Congress told us to do, and that we've got to get in the business of doing.
Yeah, if I could take you in the meeting a little bit. This is your first meeting.
We are the signal.
The board
Retail.
members
We
seem
are the signal.
fairly
We are the
hawkish when
people.
You, listen to,
You understand?
In general, when you
How do
listen
you
to what
get
they're
it?
saying, was there any
We
discussion
are the people. We
of
the
a rate
people.
cut going forward?
We are the signal for
There was
the
one proposal
policymakers
on the
and the
table.
economic,
There was
monetary
no discussion
policymakers,
of any other proposal.
all the decision makers
The
globally.
discussion on that proposal, I would say, was quite limited.
We get to tell them what
the
to
group
do.
was unanimous and unambiguous
some
on
way.
it. It has been
As
the
a collective
practice
unit of
of
consciousness,
this central bank
obviously.
and others to have a range of alternatives. Today we had one. I thought it furthered discussion, deepened it, and made it clear what we needed to do and how we needed to deliver. I wouldn't prejudge what happens in the future, but there was only one big subject for us. We took it on. We had a good family fight on it for a couple of days, and we ended up, I think, in a better place.
Claire.
Thanks a lot, Claire Jones, Financial Times. Coming to
5,
this
6
blind,
years of
reading this very nice
above
short statement that I think we've all appreciated
target
in the
inflation.
room. One
Needs to
might
be
wonder
undone
why
some way.
you didn't raise rates today, considering what you're saying here about the risks to U.S. inflation and your mandate. I guess why not, and what would you need to see in order to get to that place? And secondly, on your task forces, are there any best practices at other central banks that you'd consider looking at? Thank you.
Yeah. I'm glad they're in the practice of giving you two questions, because my answer to your first question was going to be very curt. I've got nothing more to say than the statement itself. And to the point of the question I got before, market reactions to what we say unfiltered, I think is more helpful than having delivered a statement, me then improvising further upon it. Best practices of task forces. This is a subject I've thought some about. I've been on a task force or two in my life. Best practice, find the best minds. Ensure that the task forces have a range of people, both by backgrounds and predispositions, so they too can have a bit of a family fight. Make sure when you establish a task force that the group that's going to be the recipient of the information feels as though they've got some equities in it too. That's why we're looking for, haven't done the final roll call, some of the most significant talent we have in the building and across the reserve banks on each of these, and in some sense seconding them to this group for a period of some number of months, so that the leaders of the task force know what the most analytical central bank in the world thinks about that.
Right back to the VWAP.
They can reflect on it. And a final best practice, we're not outsourcing decisions to anybody. Administrations past and present, reserve banks have chosen a group of 19 people around the table. These will be our decisions. We can agree to some of the recommendations, disagree with others, have a good family fight about it. But what comes from them will, I hope and believe, make the discussion we have internally better, stronger, more of a dialectic, so that we can finally deliver on that price stability objective.
Just a quick follow-up on your markets point. If you look at 2-year yields, they're really suggesting that markets think more tightening is needed. Would that be your read on what the 2-year yield is saying as well?
We were in such a good place. This is why we don't do third questions, I presume. I'm not going to offer any commentary on market reaction over the last 30 or 60 minutes. What we've given markets is a new chapter for the central bank, some fresh thinking. What we've given markets and households and businesses, I think, is a commitment to ask ourselves hard questions such that we can deliver on the promises that we've made before. This is a lot of change for financial markets to digest. I wouldn't be particularly intrigued by how they react in the first several minutes or even first several days. What I think is most important is that financial markets, and at least as important, households and businesses know that this central bank will deliver on price stability.
Brian.
Boom.
Hi there, Chairman Warsh. Brian Chung with NBC News. Thank you for taking our questions. So when you say that we've dropped forward guidance for the layperson, that might sound like the Fed's going to say less or offer less insight into where their borrowing costs might go. So for the person that maybe you might run into at the grocery store, where the price tags are rising at a faster pace than their wages at the moment, how would you explain it to them? I don't know if task force might be the answer there, but how would you kind of communicate this era, this chapter of the Fed?
If I told somebody in the milk aisle that I had a task force for that, I think that would be doing a very poor job, so I appreciate it. If I saw somebody in the grocery store, what I would say to them is that we cannot have a very significant effect on particular prices. The price of oil in the markets today, or even the price of a dozen eggs, that does not have first order consequences to what we're doing. Yeah. But we do have a really important job there, and it's to make sure that those changes in oil or beef or eggs or milk don't broaden in the economy, don't have second and third order effects. That's our job, that's our commitment, that's our capability, and we're going to deliver on it.
And then is the Fed's relationship with the Treasury also under review? There was the normal breakfast meetings with the Treasury Secretary. Is that something you intend to continue doing? And have you had conversations with the President since you're swearing in?
So on the President, I don't have anything for you. With respect to the Treasury Secretary, he has been posting pictures of our breakfast, so I don't think I can deny that. The long tradition at the central bank is that the Fed chairman and the Treasury Secretary meet weekly. I think we've pulled off 3 of those so far. I believe he's overseas this week, so this will be the exception to the rule. I think they're very useful discussions. The central bank's objectives and our roles and responsibilities are quite delineated from the fiscal authorities. And in my view, monetary policy is independent in the conduct of what we do. But that doesn't mean we're not interested in what's happening with the fiscal authorities. The way I think about it is this central bank needs to have a wide lens, but a narrow remit. We need to be quite interested in what's happening in the world. I won't be breaking any news here to suggest I'm quite interested in what's happening in the Middle East. That does have some effect on our day job. It doesn't mean it's our responsibility, but I think we're going to keep a wide lens, and my meetings with Secretary Besson to this point have helped widen that aperture So we're aware of things that could affect our day job, even if it isn't.
Steve?
Steve Leisman, CNBC. Mr. Chair, thank you. Mr. Chairman, thank you for taking my question. You had said in the before you became chairman that you thought productivity was a reason why the Federal Reserve could lower interest rates.
Exactly.
Do you
That's
still
my
believe that
thesis.
to be
That's
the
my
case?
whole thesis.
So
That's my whole thesis. There you
committee
go.
had a discussion of productivity today. AI came up. The
Yep.
way I thought about it before and
we go.
socialized with the group is that artificial intelligence, the latest generation of general purpose technology,
Disinflationary.
is perhaps as important a change in the economy and business and households that we've had in my adult lifetime.
He's not even talking
It
about
is filled
Bitcoin,
with
crypto either.
both a huge opportunity and with risks. I take both of those very seriously.
Little do they know.
You may have heard me say before that AI is shorthand perhaps for American ingenuity. That doesn't mean that it's going to be easy. That certainly doesn't mean it's not going to be disruptive. But over the long term, my conviction, and I heard quite a bit of support for this around the committee today, is the United States is a winner as we go down this. The United States is ultimately going to be better off in that. Now, to bring that back to the conduct of policy, timing, scale, speed, implications for output and employment, it's one of the things we have a task force to do.
If you don't mind, a follow-up from the other side, which is that when you look at the strong job growth that's out there, the elevated inflation, GDP seems to be going pretty good, and the stock market seems to be soaring. Do you look around this economy and see the funds rate being restrictive?
So that's your second question. I'm going to give the same answer that I gave before. I'd say as I think about the conduct of policy, what matters is what's the effect of policy. Not what do we say, but what happens. And the best way I can describe it is it's uneven. I do see some restrictiveness in things like housing. It's hard to use those same words anywhere else. I'll just make one other point. You talked about one of our dual mandates and the employment
American
side.
ingenuity.
I don't believe that we have a cruel choice. I don't share the view that was expressed a few generations ago that Federal Reserve chairmen show up at a podium like this and say, you got to choose. And you're going to have to decide whether you're willing to tolerate higher inflation to put more people at work. I don't believe in that. What I believe is if we do our job, we can make strong growth, low prices, and strong employment mutually compatible. And so what you heard from the committee today is we've got some work to do on the price stability front.
Nick?
Thank you. Nick Timmeros with the Wall Street Journal. Chairman Warsh, you've said repeatedly credibility is earned by delivering. If credibility requires delivering, the move would be to tighten or at least to threaten to. Now, you didn't do that today. Why not?
That judgment you expressed was not expressed by any of the 19 people around the table. We'll be meeting in 6 weeks. We'll take up the issue again.
And if I could ask about AI, the build-out is generating enormous demand right now, CapEx, data centers, power. The productivity payoff may be further out. So in your judgment today, is AI adding more to demand or to supply?
It's a good question.
Demand.
At the central bank and an economics
In my view,
profession,
demand is
what we
coming
spend
up
most
heavy.
of our time doing
Hardware
is
demand.
counting demand. It's easier. We can see it, we can count it, we can check it, we can revise it. What we do, though, is we infer supply. You'll notice in the second paragraph of what one of your colleagues described as a very short statement, we have a sentence on the demand side and a sentence about the same length on the supply side. They're both important. Just because we can count one better than the other doesn't mean we're going to favor one more than the other. With respect to AI and the growth of data centers and infrastructure around it, we're counting the demand side, and it is no doubt showing up in GDP figures. We can be less certain when we infer the timing and extent of the growth in the supply side. It may well be an intuition the supply side is going to expand, but it'll take longer. I just describe it this way. There's a race between supply and demand. Milton Friedman says that the only thing we know about economics is that there's a supply line and a demand line they ultimately cross. When they cross and what are the implications for policy? The good news for you is we have a task force for that.
Andrew.
Thanks, Mr. Chairman. It sounded like on the task force on data that you were looking at overhauling or completely overhauling the system of national accounts, the way the government mines the economy. Is that your ambition?
In a word, no. In a few words, much of this data gathering happens in other government agencies to which we owe a tremendous amount of respect, tremendous amount of deference. But if in the course of this we come up with recommendations, which Fed staff have already begun to develop, about things that they could be doing to help inform us as policymakers, we're not going to hesitate. Again, I don't want to try to delineate the four corners of the research of the task force on data, but I do think there will be a review of official statistics, and at least as important, a view of bringing the best practices from the private sector and new analytical tools made possible by AI so we can forge these into a fabric that gives us better real-time information. So as I mentioned before, when we're making decisions that we'd say are real contemporaneous data, not data that we call contemporaneous, that's really an echo of history.
Okay, thanks. The other question I wanted to ask is related to the building renovations. Are you considering any changes to the renovations, the projects, just in light of the fact that they became kind of a political football in the last year?
I heard something about that. I don't think I'm breaking any news, but my view, when you show up at a new institution, you should go meet with the Inspector General, just as a matter of good practice. It's a practice that I hope to continue. I've had one meeting with the Inspector General, and he told me what I believe the world knows, which he'll be coming out with a report on the building and the building projects at some point later this summer. I'll be interested in reading the report. From my perspective, with a forward-looking glance, is there anything that we can be doing or should be doing from this moment until the completion of the project to do what we can to be good stewards of taxpayer money and make sure that we're delivering on the promises that we made? Some more work to do. You might not be surprised in the first few weeks. I've been somewhat preoccupied on other matters, but I promised to get to the full breadth of the Fed's tasks in the weeks ahead.
Victoria.
Yep, there he is. Plan to unfold over time.
Hi, Victoria Guida with Politico. So I know that you did not submit a forecast, but you are the person who is authorized to speak on behalf of the FOMC. So I'm wondering if you could tell us in the SEP, the increase in the expectations for inflation, is that all because of the Iran war? What was the discussion around the expectations for inflation being higher and also potentially growth being slower? So
my read of what I heard in the room reflected, I must admit, in the SEPs, is half of my colleagues thought the policy rate, given all those developments, should be at this level or lower between now and year end, and the other half thought higher. That 19th voter was me, and I didn't submit one. There's a range of views on the questions of first and second round effects, no resolution or conviction, but we'll be meeting again in 6 weeks. I think we're going to know more then, and I think that my colleagues are very attentive to incoming developments between now and then.
And can I just quick follow-up on the SEP? You said that you're still encouraging your fellow committee members to submit forecasts even if you're not doing it. So what do you think is the benefit of them doing it even if you don't?
That's the commitment that the FOMC made, and it's a commitment that I hope we live up to. Commitment we made was to deliver price stability. I expect us to live up to it. By the time we get to the end of this year, as I mentioned, I wouldn't be surprised if there was a new communications framework. There were some changes to the SEP. That's a committee discussion, a robust discussion. I think we'll have it. I believe we're going to come to a better mix of communications to deliver on what we promised, but I wouldn't want to prejudge what those are. But between now and then, I would continue to expect colleagues to submit their SEPs. Some of them, I think, believe that the practice is currently structured is okay. But I heard a lot of interest in real reform, generally about all these topics. You didn't ask it, but I'll answer. It was a pretty gracious couple of days, and it's been a pretty warm few weeks. The institution wants to figure out how we can do better. The institution's going back to first principles, and I'm encouraged that what we've done in the statement, what we're thinking about doing with respect to the SEP, that instinct towards a new chapter is a real one, and by the end of the year, I hope we can put some points on the board, both in form and in substance of delivering.
Go to Enda for the last question.
Thank you, Mr. Chairman. Andy Curran, Bloomberg News. Could you guide us through, please, some of the principles that guide your own reaction function, and tell us a little bit about the kind of conditions that you think when the Fed should respond?
It's going to be a very unsatisfactory answer to the final question. The Federal Reserve has a lot of responsibilities, not just in monetary policy, but in supervision and regulation, consumer affairs, and payments. My own view is our credibility comes from delivering on what we're saying we're going to do across everything we do. I've devoted more time in my first 3 weeks to monetary policy than all those things. But the more we deliver on our promises as good supervisors and good regulators, the more benefit we get, the more credibility enhancement we have in monetary policy. When we deliver on our price stability objectives, which we will, the American people will feel as though the hardships that they've been living through, in part because of inflation in the last 5 years, are in the rear view mirror, and that credibility will have dividends across what we do, and the institution will come to press conferences like this, always with an impetus to reform, always with an impetus to do better, but we're going to put some points on the board.
And Mr. Chairman, we've had strong labour data in recent months. How would you sum up the labour market right now? Do you see it as stable and as potentially a source of inflation? Thank you.
Yeah, so the committee, if I were to try to capture how the committee thought about it, the committee thought that the labor markets were stable. There were some people around the committee who thought that it was trending better than that. Trends matter more than data points. What's happening over 3 or 6 months matters more than any one data point, any one data release. And I'd say the jobs data has been moving in a good direction. If I heard one other thing around that subject over the course of the last couple of days, what I heard was that strong productivity-led growth is not something that we fear, but something we embrace. Thank you all very much.
All right, well, that's the meeting with the new Fed Chair, Kevin Warsh. Got an interesting move on the chart here. We made a move all the way back to the high, and then we got this break back down, and then we kind of just swept this level again right here, almost like a higher low, but mostly chopped today. We've been going sideways most of the day. We had these couple moves up and down and back up, but so far there's not really a lot of movement. So I still don't see much of an opportunity for a trade right now. But Kevin Warsh held it pretty strong, pretty stable, and pretty straightforward going into the first meeting. I think that all the things that he said kind of align with what I'm thinking about and what I understand about his take on monetary policy and the inflation, the persistent inflation. He basically said all the things, AI productivity, the energy supply shocks. He said they'll deliver on price stability, sustained inflation, and yeah, I think he really has I believe that he has a plan, a pretty vast and deep plan for how to make tangible, substantial progress in monetary policy and with the economic measures that people have been struggling with over the past 5-6 years, and even 8, 9, 10 years realistically. So I think Kevin Warsh is going to come in hotter and hotter for the next year or two. After each meeting every 6 weeks, I believe he's gonna be unfolding his plan, and it has a lot to do with some of these deregulations and some of the crypto policies that are coming out and being worked on right now, like the Clarity Act, the ARM Act, and quite a bit more with the balance sheet reductions and supporting the bond market. So still no trade, have not, not really interested in taking a trade during the press conference or anything like that. I'm just looking to, these contracts have come down quite a bit though. Before the release, these at the money calls and puts were both at like $300 each. Now they're about 100, 150. So I could go about 4 or 5 strikes out. And my idea of the risk management for today would be, I would be willing to risk about $40 across 2 trades in order to capture some solid movement. So I would look to take a $20 contract and take it almost like a trade for 0 with the $20 contract, or if I take something upwards of like a $30 maximum position size, given my account. It's still too high of a position size relative, but my account is still very low. My account's at $145.57. It's up 188% over 3 trades, but really is not much in terms of my ability to improve my risk management. So I'm looking for $20 to $30 contracts with some solid momentum. Maybe if we break down here, we can get a solid move down towards that 720 level, which was we pull it back up. I think the 4-hour chart, where we bounce off of on QQQ. Let me just pull this up right here. So what I'll be looking at for a trade right here, if we're gonna come in for one, this 4-hour chart, we had a nice bounce off the 21 here, right at 725-ish. But on the daily chart, you could see that it's the same. The 21 on the 4-hour is the same as the 9 on the daily, in case you didn't know. The other thing is the 21 on the daily chart, which is down here at 720, 719 actually, which is about $10 down. So if we do start to slip down here, that could definitely be worth the play. And given my risk management, I'm looking to only take about, like I said, $20 to $30 contracts. Just remove this cursor. I don't need. Kind of annoys me to see the cursor moving around when I'm not like trying to use it for something. So I'd be looking to take maybe 1 or 2 trades, $20 to $30 contracts, risking about $15, $20 each in order to capitalize on decent outsized return potential. Definitely to the upside, the contracts are cheaper. The 730 call is 90 cents, the 733 call is 25 cents. But on the downside, they're a bit more expensive because we have the down move since that beginning of the meeting at 2 p.m. Eastern. And we had to move all the way down, 724.55, and then move all the way back up to the high day at 735.68. Now we're back down looking at this support, or this support that could break. We already tested resistance on the upside after these moves, after that fake move and then come down. That was the Kevin call move, those 2 big green candles. That's the Kevin call. I called it perfectly on time, right at 2:31 on my Twitter, I posted the chart just for reference. I'm gonna collect the charts over time so I could demarcate them through time to improve my visual study of the FOMC and the market with reactions, as we have done in the past with Jerome Powell for the past 4 or 5 years or longer. But on the downside, so like 725 puts, 72 cents, 722 puts, which is another 3 strikes down, is 30 cents. So they are a bit more expensive. There's a candle closure right at that support area. On the 1 hour chart, it's a nice inverse hammer candle here. And I'm not sure how much time is left on that. Let me just see real quick. How much time is left on that 1 hour chart candle here? 9 minutes and 23 seconds. This upside down hammer candle right here is pretty interesting. Can I still see this? Well, yeah. So if this closes down here, this is pretty decent. We can come in. The close here, it would really be the high of day from this day. I think that's the same level I was looking at before. Around 724. But yeah, so that's we're getting that move there. SPY's right into that daily 21. So that's coming right up. It's already lost the other ones into the gap. Contracts are getting quite expensive. Even the 720 puts now 30 cents. So entries are going to be very difficult if I want to get that cheap price. It's only 40 minutes left in the market. Okay, we're breaking the support, coming all the way down, nearing that low of day again, 10 cents off, 10, 15, 20 cents off that low of day. All right, let's take a look at this, see if where would this present an entry. Let's see how this 5-minute candle closes. If it closes on the downside, there may be a retest somewhere. But we may have already done the retest right there at the VWAP 21 cluster. 921 VWAP cluster. 720 puts down to 16 again. 722 puts are down to 28. The candle's bouncing off the same area. It's a lower low. Well, it's technically a higher low still until we break low a day. It's higher low. Higher high, then a higher low. The price action is quite wonky, but that's typical of these volatility and during these type of events and when important speeches are happening. You see it's coming back down at the low. Ooh, these contracts are moving crazy. Up like 100% in a minute there from the 722 put. Wow. This could be like a late entry, but I would think a late entry would be a little bit later, but the contracts just don't align with my late entry right now. The price of the contracts are a little bit too much. They don't align with my late entry strategy. Like here would be like kind of a early-ish late entry. Like the late entry would be after the close at the low of day, and I would like to think there would be another retest, but it's not a lot of support right there. We have a level down at 721. I mean that's the only level, right? 721. I mean, obviously we do have the 21 on the 4-hour chart, which is somewhere around 725. So, but that's right around that low a day. I mean, we're already like almost there. Breaking the low a day would put us below that. Any closure below that, it's the same thing as the 9 on the daily, and that would bring us down to the 21 in the previous gap support level, which the gap daily candle closed at 721.34. Obviously, the 21 EMA on the daily chart's at 719. But the close on the gap is 721.34. That's still $3-4 down, so the opportunity is still there. the late entry could still happen, but contracts are expensive. I really wouldn't want to go deeper than a 720 put. It's like 30 cents right now, so it's at like the highest price I would want to pay, and we're not even breaking low a day. I'm gonna go get a coconut water. I'll be right back. See how this plays out. See how it plays out. 1 second. All right, we close the candle before low a day. Okay. Coconut water. Coconut water. FOMC meeting was solid, though. I feel optimistic about it. Kevin Warsh came on with the confidence and the straightforward, with the mission-driven statement. Kept it simple. I really do think there's a big plan that's going to be unfolding over the coming months and really the next couple of years. The FOMC meets every 6 weeks. With the disinflation theory supporting the bond market as it is, transitory, persistent, or as Kevin Warsh said, sustained inflation, the AI productivity with the energy supply shock, the divergence, their plan to deliver price stability, the creation of these Fed task forces to delegate even more decision making and thoughts and communications across all the different areas and sectors. I think it's going to be a good time, great time. And like I said in the beginning, the most entertaining outcome is the most likely. And that's the big takeaway. Well, that was the takeaway initially that, I brought into it. And I think that's exactly the way it's turning out. I think Kevin Warsh is the right guy for the moment. I don't think there's few other people who would have a strict, deeply embedded plan to upend and to fix in a real way, sustained, substantial way, the modern economy and where we're heading, including the difficulties with the international trade and foreign conflicts, etc. I just think it was pretty solid for a first meeting. I think it was really good. I would give it like a 9 out of 10, honestly, at least a 9 out of 10 in my view. And they held back on a lot. They really did. There's a lot to talk about. And he kept it very straightforward, simple, brief, reduced the language by a lot, by like 70-80%. Went over pretty much all of the things that I mentioned in the beginning. Besides the Strategic Petroleum Reserve, he didn't mention anything about that, or crypto. He didn't mention Bitcoin, crypto, or the SPR. Even the dollar he didn't mention. But everything else he went over pretty solid. Good meeting. FOMC is always very insightful to study, take notes, and understand the bigger, broad picture of the economy at stake. All right, so there, we did get that candle, so this would be another spot on this this candle breaking down, still not below support. Candle closed at a decent spot. We're breaking or pushing back up into the candle all the way 78.6% into the candle, back into this prior support, acting as resistance here. Could be relatively decent for a trade, but the entry's already kind of lost there. 720 put's only like 22, 23 cents. It's almost worth it. Almost. I think 721.34, that level from the gap level, 721.34 is pretty good. It doesn't have to happen, but I think that's kind of the resolution I would expect here out of the low a day. As long as we break the low day. If we don't break the low day, then this could just chop around, which is not ideal for trading. 720 puts at 20, 22. 721's over 30 cents, so it's not quite worth it. I don't want to spend more than 30 on a contract. But yeah, let me pull up this. Should be good. Obviously, this is not going to show my positions. I'm going to try to take the 720. Well, it's not going to let me get it moving too fast. Okay, well, it did fill. You can see, actually, it does show the build. It does show that there, so that's interesting. I took a 720 put for 30 cents. Like I said, I'm willing to risk $20 on this trade, but it's not ideal. I would like to see that low a day break, but let's give this a test. And it kind of shows P&L percent. It just doesn't show. It shows the entry, and it'll show the exit on that, but it only shows up for a second. Thinkorswim, the platform I trade on, it really doesn't have much of a good way to view your actual open positions and your daily positions with everything looking decent and not too complicated, so it's not really ideal. All right, we're already getting a bounce up here. Contracts already down like 50% almost. These contracts are moving a lot, so. But I'm gonna hold this a little bit. I really do think as long as we hold below this support in these previous candle high, the upside down hammer candle right there, as long as we hold below that and the 9 EMA there, as it comes down, we have a very high probability we're going to break low a day, and I think maybe it could bring us right down to that 721.34 level, which is the daily gap level. From the gap, I believe over the weekend from Friday's close was 721.34, and that's the level I'm looking at. Contracts at 25 cents, almost back to break even. See if we can actually flush this low a day and not like do this weird sweep that we've done a few times. I think if we break here, we can actually get a decent move down. Contracts back into the green, barely. Back above break even, we're breaking low a day. Let's see what kind of momentum is here. Right now, we're not seeing it too much yet, but we can get some momentum to come in. Push back up, 725. We made a low a day, but not done much, so let's see. I'm not sure. It's moving. This thing is moving crazy though. Price action is pretty volatile right now. Yeah, honestly, right here would have been a better entry for a later entry. 22 cents for the 720 put, which is the strike I have. 720 put right here would have been a much better entry with a little bit more confirmation. I mean, this candle closes in a minute, but I think this is more of a late entry. We already broke the low a day. It's more confirmed. We'll let it do what it's going to do. See where this candle, if it closes at low a day, and then we could get that move down possibly to 721.34. That's a $3 move from here. I mean, that would be pretty significant. Can happen quick though. Yeah, I mean, it is like a $10, $12 move from high to low. Pretty solid. Pretty solid, but it doesn't feel like much just because the way the contracts are priced, it feels like it's hard to take advantage of, especially with my account size and position size. Looking pretty waterfallish. See if we can pick this momentum up. Anything under 723, I think, can be pretty decent in it if it happens quickly, but down to 724 at the low there. You know, contracts are moving volatile. They're already down 50%, even right here. Crazy. Contracts at 20 cents. They're just really volatile. If we get the $2 or $3 drop from here, that would be like probably the only way that these contracts can accrue enough value at the money. Because obviously it's a 720 put, which is even below the 721.34 level that I'm basically targeting. So it's not ideal, but you know, got to take the risk to find out. It is increasing volume though. I mean, on the 2-minute chart, increasing volume for 8 minutes going into this candle. This candle's inside bar still. Not ideal. Now it's moving upside. Not good. Contracts down 50%, exactly. 21 still up there. 9 EMA still up here. Pretty close, but not ideal. I don't even want it to go up there. It's too much, way too much. Not much for a new low a day, like at all. It's not much of a new low a day at all. That's the problem. Not a significant low a day, so contracts even here is down 50%. Ugh. Yeah, it's terrible. Yeah, this is sketch. I don't like this. The momentum's just not there right here on this sell. We made a new low day, but barely. Held 724. It's still way out the money, 4 strikes. No good. The momentum needs to come in if we're gonna actually sell down here. So there, see under 724. Let's see if the momentum is serious, because what we need is to move down to 721.34. That would be a solid close of the gap. And that could definitely happen into the close, but there's actually only 22 minutes left. Jeez, only 22 minutes left in the day. Contract's up only $5, up $7. I may not get much out of this. I'll probably take profit early because I kind of have to here, but we'll see. Obviously, I'm looking for at least under 723 here, solid. Maybe it has to be more than that though. Maybe even 722, just because these contracts up $10, which is like 30%. It's up like 30%. We're at 723. Contracts, okay. I'll probably sell the contract here. Anything above like 50 cents, that's a $20 profit. And I would be interested in taking that. But right now it's, what, $13? $10 profit. But we need to get a little bit lower than 720, down to like 722 at least. But, you know, that's going to bring in that 721.34 level. It can happen quick, but so far the momentum just hasn't really like came in too strong. It's starting to come in a little bit here. Okay, we're down almost to 722 here. Contracts at 60. I'm gonna take it off for 100%. Call it a day. There we go. Sold it for 68. That's a $38 profit, 111%. My account's up to $182.25. I only had to take one trade. My P&L year though, it's unfortunate to see. It's negative $645, but I've done a lot of random trading earlier this year, even before March when I started this. And I've only been taking it serious since March. So, but I'm down $645 year to date. That's like $300, $250 of that. No, I've only reset my account 4, maybe 5 times, which is $250, only $50 each time. So since March, I'm down like 200 to 250 maximum. And that's not counting my account right now being up 200% or whatever, but yeah, so that was pretty solid. My thesis played out. We broke the low day. We got the momentum with the waterfall down to 721.19, low a day. My target was 721.34. Perfect solid hit, perfect gap closure. And yeah, very solid trade, I will say. So now let me pull this back up so you can see this gap has now perfectly closed. This is exactly what I was looking at. This is the target. If it'll just load the 21 on the daily though. It's so slow to load. There's the 21. We're not even there yet. 719, but I'm not expecting 719, but I was expecting this gap to possibly close in this 21. They're around the same level. So far, that's exactly what's happened. Let's check the dollar. It's actually going up over 100. This is not a good sign. Over the past month or 2 months, the dollar's been increasing. That is not a good thing, but it's been in this base. Obviously, it was much more volatile last year. Before this year, we've had quite the positive improvement. I'm not even sure exactly what caused this massive sell-off and this flip from support to resistance here. I speak too fast. Yeah, the dollar is increasing, but it's still at the same mid-level that it's been at for 3, 4, 5 years. How far back does that go? I mean, really, since 2022. This is a little bit different. This was the pandemic drawdown, and then the drawdown here, and then the increase. And the dollar rose with the bear market, with inflation being very high, up to 9% during 2022. Bitcoin hasn't done anything for quite a while, and then the oil price is still very bullish. So that was it. Target 721.34, perfect. The analysis was spot on again. Only had to take one trade. It was pretty sketchy. I mean, the lowest it went was like negative 50 to 60%. It went down to like 13 to 15. I would have ideally stopped out at like 10 cents, something like that, which would have sucked, and I tried to avoid it. And I would almost just let the one trade play out as long as those all those things I said held, which is the reason why we ended up we did end up going down to 721. That is that's the trade there, down to here. See if it actually somehow goes all the way down to the 719 area. Not expecting that, but yeah. So there's the account. Real time. My entry on the 720 put was exactly at 12:30. 9-minute trade for like 111% or so. Only one trade today. I really was thinking I might not even end up taking a trade, but we ended up getting a decent setup going into that close there, so that it was worth it. Even though I had, of course, had to have a 50% drawdown. Most trades I take, they have a 50% drawdown. and then they end up playing out and going 100%, or they'll go 100% and then go down 50, negative 50, and then they'll go 200 or 600%. It's like ridiculous, but that's also the problem and the issue, the difficulty about trading and risk management during power hour, the final hour of the day, which is what I'm focused on because of the contract prices. Because my account is so low, if I had a higher account, I would much higher dollar amount in my account, I would be swing trading, and I would be trading in many different ways, but the day trading side of things would be much more risk averse while still going for asymmetric returns. So it just is what it is. All right, market close in 14 minutes. We just go through some of the other information, a little brief on what was said during the Fed meeting, FOMC meeting. Kevin Warsh said AI is the biggest change in American society in his lifetime. And he also said that AI is shorthand preps for American ingenuity. And the development of the task forces for communications and finding analytical ways of coming to conclusions around price stability among institutions and experts is pretty good. And like I said, I think there's a big plan, and there's a lot of things a lot of depth behind it that needs to be unfolded over time. And he said that there are some changes to come, and they may be worthy of press conferences, because one of the questions was, are you going to reconsider and do you like coming to these press conferences and answering questions, etc.? And he reiterated that they're worthy of many of the ideas in the transparent communication through the Fed to not just experts and investors, but households and people who are looking to understand, seeking understanding around the current monetary policy and the current economic environment, which a lot of people care more about than politics, which is the truth. They've held rates steady. And he says for 5 years they've missed the inflation goal. They're going to fix it. Say they will said they will deliver. We will deliver price stability. Kevin Warsh said inflation is primarily determined by monetary policy and suggested current policy appears restrictive for the housing market, but less so for financial markets, while also signaling a broad year-end review of Fed communication tools, including the dot plot, press conferences, and policy meeting practices. prompted by the same question. And he reiterated his opposition to forward guidance, saying the Fed has removed it from its communications and cannot provide advanced signals about future policy actions. Which is somewhat unfortunate, but ideally it's the right thing to do. Preferring to respond to incoming data, real-time live data, rather than pre-commitment to any rate path. Shorter Fed policy statement is intended to give you the facts. Forward guidance and Fed statements not so well suited to current policy state. Establishes new independent task forces in 5 key areas. Task forces will propose next steps, including changes to the summary of economic projections. The Fed will be maintaining its 2% inflation objective. The Fed policy appears to be restrictive for housing, but not financial markets. Most of the data they consume and we consume has old-fashioned survey methods. Most central bank data relies on those methods, and it opens the recommendation from Fed Data Task Force on improving official statistics, which is great for everyone, really, to have transparent data, more real-time accurate surveying. He said markets perform best when reacting to incoming data. Financial markets act less efficiently when they are worried about how the Fed will react to the data. That's the reverse psychology there. The financial markets just basically need more confidence in what they would call clarity. What, from Kevin Warsh's own words, is economic clarity. All right, so the QQQ is down 1.17%, and SPY is down 1.38%. So QQQ is stronger than SPY today, even with this sell-off, this waterfall into the close here. 8 minutes left until the close. We're making a new low a day under 721. I don't think we'll make it down to 719. Maybe early morning tomorrow we'll tap 719 and then bounce and rally off of it. That's what I would expect tomorrow. And tomorrow's technically the Friday. Tomorrow, triple witching. It's a holiday. Or on Friday. Tomorrow's triple witching because Friday's a holiday. So I think tomorrow we may, even if we gap down or if we hold steady, I think maybe somehow we tap that 719 area and recover the 721.34 area early tomorrow and then rally, and then maybe later in the day that there could be an opportunity for some move. I would hope there wouldn't be chop, but I would do the same. I would take a very similar risk management strategy tomorrow, only looking to risk $30-$40, maybe $50. That's kind of too much, but risking that amount in order to take 2 to 3 trades, depending. Take like 2 $20 trades or a $20 and a $30 trade. On the $30 trade, I would stop out with like 5 or 10 cents. I would ideally want to lose 15 to 20 max on a trade. But the other trade, if I take a $15 or $20 contract, if it's cheap enough, then I could play it for 0. And that allows you to trail your stop much easier and allows you to capitalize on a bigger move. Just like I did the 250% trade 2 days ago or yesterday. I can't remember the specific day, but the trade I think yesterday was 250%. Yeah, from 38 to 98, or 33 to 98, something like that. But anyways, SpaceX is actually red today, back below 200. Let me see, where is The VIX is up 14%. Robinhood's over 100 today, 9% on that. We still got Nebius, Marvell, Broadcom, Rivian, Oklo, Intel, all green. MU, Micron. AMD's green by 1%. But Q's is down 1%. SPY's down 1.3. I'm not seeing SpaceX. I don't know why. It's at the very bottom today. Yeah, it's negative. SpaceX negative 5% today, down to 191. So it got the 40-50% move from the open, 150 to 220, 230. Now it's pulling back. We'll see what happens. But the lockups are being unlocked over time, over the next several months. Going into 2027. By the beginning of 2027, that's when Elon Musk shares are unlocked, which is the final 40% of the float that's locked. So there may be that liquidation coming over the next several months, maybe even into early January of 2027 or early February. And that's when SpaceX could be at the best price to go long term on it. So that's what I would ideally like to see. There's a good green candle after a sweep of the low a day. Into the close with 5 minutes left. Hold on a second. All right, so that's it. 3 minutes till close. Rates are unchanged. No one really, people want 9 out of the 18 Fed members want a rate hike, and they're projecting a rate hike in the coming few meetings, but I don't think, or in the coming months, but I don't think that's going to happen. There is actually still a possibility, and it's priced in, 1 rate cut still by the end of the year, which I'm expecting in September, October. And the Fed, the new Fed mandate is maximum employment, price stability. Obviously, they're going to solve the price stability. They will deliver price stability in their words, but also fixing 5 years of inflation misses and inflation mistakes, which I wouldn't categorize it as a mistake, or but you can categorize it. Obviously, during Jerome Powell's last 4 or 5 years has been mostly, missing and having that difficulty with the inflation, and that's really 95% to do with COVID and the pandemic in 2020. And they were reacting to market, reacting to the Fed, reacting to economic uncertainty, and so now economic clarity is what really matters, and that's what the new Fed with Kevin Warsh will deliver, along with price stability, maximum employment, 2% target inflation still remains. Maybe in the next 5 years, call it 2020, 2031, we will have 2% inflation once and for all. That doesn't mean that it can go to 2% and then take 1.8% in 2030. And then next thing you know, 2032 is back at 4 or 5%. That's how inflation works. It's a long process. It's a long dismantling of forward expectations from the public and from the market, the free market, in order to revive the confidence, which is what he's talking about. The confidence in monetary policy and the Fed's independence is what matters. So I think it was a great day. It was a good Fed meeting. I got to look into it more. I got to even watch it back again and take some more notes. But I think it was pretty solid. It was pretty straightforward and concise. And the trade today was pretty solid. That was trade from $30 on the 720 put all the way up to 68 cents, where I took profit. We ended up getting a low a day of 720.85, which was below my target of 721.34, which is the gap fill. So that trade returned what would be, what is that? I said 111, but it's actually 126.7%, 126.7%. 126.7%, which is pretty solid. And my account now from where it was, my account's at $182.25. $182.25 from $50.53. My account is up, well, now 260.67%. 260.67%, pretty good. So that is pretty much it there. So I got to go do my journal, and then tomorrow's basically the Friday for the market, so we'll be looking for a similar opportunity during the final 2 hours, basically, maybe in the last 3 hours, I don't know. Probably going to be kind of maybe a boring day, but it could also be pretty volatile because of a meeting today and triple witching tomorrow on options expirations broadly, so we'll see how that goes. I'm gonna go ahead and get out of here now, and yep, have a great day.